Canadian budget just came out. Should we file it under G? Yeah, you know what I mean. All this and more with a good friend and mortgage broker, Mr. Dion Begg. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Begg. How you doing, my man?
Excited, Gary. We've got a lot to talk about today. Lots happened in the last week or two. So with this budget and how it may affect you and me and every Canadian. So let's jump into it.
Let's jump into it. And I know, we know, Dion and I know that everybody and their brother and possibly mother has been talking about the Canadian budget, but it's been about a week and a bit, and we've had some time to digest it, kind of think about it. And we've got some interesting comments, and we're gonna highlight, maybe 5 or 6, maybe even 7 of the top kind of items out of the budget as it relates to real estate and everything else. But when it came out, I'd love to know your first thoughts on it when it first came out, Dion. Were you just kind of like, okay, yeah, those are talking points so we can get votes, or where do you think this thing lands?
Yeah, look, I'm not political, but I'm very aware that we're going into a campaign season with election next year. And of course, when this type of stuff happens, it's going to always impact policy, and parties are trying to make themselves look better for the Canadian people. And so they're going to pick and choose things that they think will get them votes at election time, right? So we can't ignore that fact, regardless of whether or not you're political or apolitical. This is a fact. So we should talk about these one by one and see, what they've been trying to do here to entice the Canadian people to believe that they're the party to vote for next time around.
Yeah. And our election still might be 18 plus months away. I don't know. I can't do the math. 2025, that's all I know. Here's what I do know, though, is if this budget gets passed, I shouldn't say if, when this budget gets passed, it's what we have to work with today, right? So let's learn it. Let's work with it. This is the sandbox they gave us. So we'll call it for the moment, let's go figure it out. And our role here, Dion, and like many of our viewers, is to understand that sandbox and look for opportunity and just kind of, figure it out from there. So, okay, we got about, like I said, 6 or 7 different things we're going to pull out. And the first one, of course, is kind of the hot topic in our circles at the very least, but let's kind of peel the onion away on the new improved or unapproved capital gains tax.
Right.
Let's talk about this. So on one set, the government implemented, a 66% capital gains tax, and that's all people here. Help us understand that, Dion.
Okay. So, Gary, in all of my years in business, forget about the changes that just happened. Capital gains tax before these changes has always been something that's confused regular people, okay? Because, it's 50%, it's 66.7%. Oh my gosh, am I going to lose 66.7% of my gain? The answer is no, okay? So let me first tell you what my understanding is. And by the way, I have to put forward my disclaimer. No, I'm not an accountant. This is what my accountant told me. You should check with yours. But let me tell you what my understanding of capital gains tax is. As it is right now, prior to the change, and how this change will impact. So I want you to imagine that you made a $100,000 gain. You bought something using round numbers. You bought something for $250 and you sold it for $350, and you had a $100,000 gain. Okay. Now, 50% of that right now is tax-free. So it is tax-free. So we have this acknowledgement that we're only taxing 50% of the gain. That is what they call the inclusion rate. Okay, that's an important terminology to understand, the inclusion rate. So only 50% of your gain is included on your tax return that year as taxable income. And so in this example of the 100 grand, you keep 50 tax-free, and the other 50 that you made that year is added to your income that you earn. Let's say you're a school teacher and you made 100 grand that year through your job. Now that year you made 150,000 that year, okay? And let's just say for simplicity that pushes you into a 50% tax bracket on that upper 50 grand. Well, that means that of the 50 grand that was taxable from the sale of your property, you pay 25 grand in actual tax. Okay. Put simply now, your 100 grand gain turns into 75 grand uh, after tax gain. Okay. So, or put another way, 25% off the top. Okay. So that's how capital gains tax works today. Now, what they're talking about is changing the inclusion rate, Gary, from 50% to 66.7%. So in this same example, 66.7 or 66,700 is taxable. I do have to adjust what I'm saying here because it's only taxable. This change only kicks in after the first 250 grand in gain. Okay. So the first 250 grand in gain will be treated the same way I just discussed with the school teacher. Now, let's say your gain was 350, then that extra 100 above and beyond the 250 there, that's when the 66,700 would be taxable. And therefore, it's up 16%, 16.7% is the taxable inclusion, right? Does that all make sense so far? I know I've been.
Yeah, it does. It does. So what they're doing is taking the portion above 250 and increasing that taxable amount. And there's some interesting ripple effects that we're starting to hear different conversations from different investors and owners, and let alone not real estate, but just, the grand, open market, whether you own stocks or anything like that, because this affects that too, right? From one perspective. So talk to us a little bit about if I'm a property owner, or you have one of your clients that owns a handful of properties, they've owned them for, we'll say 7, 8, 9, 10 years. What's their inclination now?
Yeah, so I mean, even before this change or this proposed change, a lot of my clients actually never had an intention to sell property. So, certainly some of them do. They'll sell them, they'll pay off other debt, they'll give cash to their children. But there is a segment of investors who really do believe in intergenerational wealth and transfer of that property down the line. And so many of these clients of mine actually have always intended to hold their property. You might say then, Dion, well, what's the point if they can't access that equity? And the thing is, of course, they can access that equity. Instead of selling the property and getting so much cash free in their hands after tax, what many clients choose to do is hold the property, refinance the property, take that cash out and put it in their bank account. Instead of paying the CRA capital gains tax, what they're doing is they're effectively paying a lender extra interest to have that money in their bank. And again, you might look at that and say, well, why would they do that, right? Because they're now paying higher interest, and that's a fair question. But the thing is, what happens and what people don't understand is they get to hold that asset. They get to continue to have that asset compound and grow in value. So instead of selling it for, let's say, $1 million today, they'll refinance it. They'll take an extra 200 grand cash in their hands, and they hold on to that $1 million piece of real estate for 5 more years, at which point, it might now be worth 1.2, 1.3 million. And then they can go on and do the same refinancing concept again. And so it's kind of like selling is, for many people, killing the goose that laid the golden egg, whereas many people would rather keep that goose alive and continue to collect their golden eggs every 5 to 10 years as they need them, while sustaining that asset that's going to continue to provide for them and maybe their children and grandchildren for years to come.
Yeah, yeah. And as I get older too, I'm looking at different ways, or I'm learning about different ways to kind of protect as much of that assets or equity as possible. And one thing which I'm totally not qualified to speak on, but I know people are starting to, people have done it for many years, and we're looking at different options, and that's through family trusts. And you can pass property on through family trusts, which mitigates, or typically mitigates the tax or the capital gains tax. So that might be something that our viewers might want to look into with their accountant and get a better understanding of that. But many many that own a number of properties that want to pass that on, not sell it, pass it on to their family or using family trust to do so. So look that up. Okay.
Yep.
So what's next on our
You know,
bill
Gary,
here?
before we move on, I just want to give more of a real life example, because all the examples in the media, I think, are on very low numbers. And I think we should talk about a high number. Okay. So I've written this down, so I'm going to refer to my notes. I want you to imagine that you bought a property for 250 and you sold it for $1 million. So you had a 750 gain, 750. Okay. Under the current structure, after tax, you'll be clearing 550. So your 750 turns into 550. Under the new system, your 750 gain turns into 485,000. So the difference between the old and the new is $65,000 on a 750 gain in this example. So it's about a 10% differential. Sorry, a bit more than that. 65. Yeah, it's about a 60%. 10, 12% differential, somewhere in that range. I don't think it's going to be enough to deter people from choosing real estate as an investment vehicle. And actually, one of those other unintended consequences, Gary, is that I've spoken to some realtors and some other investors in the past week since this came out, and they said while it hasn't changed their ideas, what they think is that more people may consider not selling their asset, right? Holding on to their asset and just continuing to rent it and refinance it. The inadvertent outcome there is that these properties, and many of which are going to be in the sort of first-time homebuyer category, they will not come back onto the market. And so it's going to potentially indirectly impact supply, right? Because these properties, which would have otherwise been sold as people retired, may now not be sold because the incentive, or there's a disincentive to sell now because of the capital gains tax increase.
Yeah. And that's the whole thing here. It's funny. They're doing some things in this budget to increase, what they think is going to increase supply. And then they're doing other things to hold that supply back. So, we're going to go through these and see what we can come up with. But that's a great point, Dion. Good stuff. Mm-hmm. Okay. 30-year amortizations for some first-time home buyers. What does that mean?
Okay. So guys, if you're a first-time home buyer, traditionally you're not putting 20% down. You don't have 150 grand in the bank, and therefore you're going to use an insured mortgage, be it through CMHC or one of the others, and you're going to put down 5% or a little bit less than, say, 10%, somewhere in that range. Now, if you have an insured mortgage, then a 30-year amortization is currently not available to you, right? You take a 25-year amortization. What that means is, the guy who can put down 20% ends up with a 30-year amortization and ends up with a lower monthly payment, okay? And so if you've got two people who are buying the exact same property, the person who puts 20% down is going to pay less, for two reasons. Obviously, they're borrowing less, but also their amortization is longer. Now, this new proposal is to come into play later this year, I believe August, where they're going to allow 30-year amortizations for first-time home buyers who are getting insured mortgages on brand new property, buying directly from builders. Okay, and so I think here, Gary, that they're not only serving the first-time home buyer consumer, but they're also serving the developers, many of which who have struggled in these last couple of years with interest rates where they are and the profitability of them, not being able to make profit, and many canceling projects, right? Therefore, taking future supply off the market, right? So that's the intention behind this, in that, if you look at point A to point B, that's fine. But again, you and I off screen talked about those unintended consequences and whether this is a real thing as well. So why don't you expand on that?
Well, the interesting thing, as it stands at this moment, 99% of builders require 20% down on properties, which
and that's because the builder's lenders require it, right?
Yeah. They want those deposits coming in within the first 90 to 120, 160 days, so they can keep building the properties or keep building that condo tower, keep building, which might the headline is, oh, we are extending amortization for insured mortgages on brand new properties for first time home buyers. Well, the amount of people that might be able to take advantage of that is pretty small. So for that to come into effect, builders are going to have to, perhaps change the way that they do some of the things that they're doing or the way that they sell. But as it stands right now, I can't think of one builder that would, at this moment, accept less than 20% down based on getting that deposit structure.
Yeah,
So
it makes me wonder if the government is simultaneously talking to banks saying make an allowance for these first time buyers. I'll put it into real dollar numbers here. Let's say you're buying a condo for 500 grand, right? If you're a first time buyer, you can put down as little as 25 grand as a deposit. But the builders and their lenders are requiring that you still put 100 grand down as deposit. Okay. Maybe, Gary, the government is trying to talk to lenders to say, look, let those builders on these select properties for first time buyers only take the 25 grand and let that ride, right? And maybe the government will be insuring them for the financing for the builder side of things. There's a lot more that needs to happen in the background for this to actually come into play.
yeah, and we're all the government's trying to increase supply as well as make housing more affordable. Yet the two cities where it's the least affordable and they need the most help, Vancouver, Toronto, prices are well over $1 million for townhomes. So this is
For
really
anything
just
that's not a condo, yeah.
yeah, that condo market, exactly. So anyways, we move on. Again, this is what we're here to do. Peel that onion away. What's next? Increase the home buyers plan limit. This might be a good thing, Dion.
Yep, it could be. So many of you know that you can withdraw funds from your RRSP to buy your first home. Or if you used to own a home and now you're buying your home after 4 years of non-ownership, again, you can access your RRSP to use as down payment. That number is currently $35,000 per person. So a couple could take $70,000 total. They're now increasing that limit from $35,000 up to $60,000 per person, or 120 grand per couple, if each of them have 60,000 available in their accounts. So, look, it's a sign of the times that they understand. It's great that they understand that people need this money, but again, the question is, Gary, how many first-time home buyers have had the ability to squirrel away 60 grand in their RRSPs over the course of the first 5 to 10 years of their working life? I don't know the answer. I don't think it would be many. I think it wouldn't be most.
Yeah. And I don't have this data, but I'm curious of what that average age is for a first-time buyer, because that would lend a little bit of insight to that. But I'm curious. Maybe we'll try and look that up for our next video. It's definitely gotten older, I would say, since 10 years ago, 20 years ago, 25 years ago, for sure.
Yeah. I will say this, Gary, I'm surprised that at the same time they didn't make some kind of positive impact on the First Home Savers account. This is only for the RRSP vehicle. Maybe it's because that other program is relatively new as well, but it probably would have been equally or more beneficial, in fact, to have this apply to that other account for taxation purposes and tax deductibility purposes.
Right. Good stuff. Okay. You and I have talked about this many times. The plan to build 3.87 million new homes by 2031. What's the gaping hole in this one, Dion?
Well, look, it's wonderful to think that this might be possible, as it would be equally wonderful to think that we could put a man on Mars by next week.
Martian's a great movie. It's a great movie.
But now we have to look at the practicality of this actually happening, right? And look, I'm not a naysayer, but I need someone to prove to me how, when we have never as a nation built more than around 250,000 homes in 1 year, how are we going to get to 550,000 homes per year, every year between now and 2031, okay? I cannot see it. I understand. I've seen Mr. Trudeau walking through a modular home factory in one of his recent promotions. I understand that 3D printing is a real thing now. I understand that to be true. These are all very new technologies, and I sincerely hope that you and I are proved wrong, right? Gary, and that this number will be hit. I just can't see it happening. I can't see it happening at the speed at which it needs to happen.
Well, there's another ripple effect here too that I don't think people talk about enough. And in the '60s and the '70s, where there were a lot of these homes built, and our top year was 1971, I think, or '72.
Something in the 70s, yeah.
Yeah, where governments and people accepted urban sprawl. So you think of downtown Toronto or Vancouver, or wherever you happen to might be, and they expected that urban sprawl. Well, now we've come to learn that it's not always the best thing for local environmentalists and all that kind of thing. So if we're not allowing urban sprawl, and there's a lot of the condo towers which need to go up, which means I don't want a condo tower near my single family detached home. There's a lot of hurdles to get over. It's the NIMBYs. There's a lot of hurdles to come over, and people will often say, "Well, we did it in the '70s. We did it then. Why can't we just build 500,000 homes?" Well, urban sprawl is a real thing. Not everybody wants it the same way that we expanded in the '70s. So that's going to have a ripple effect, Dion.
It will. And the next point we're going to discuss may, in fact, make this more possible, right? And that next point is, the funding for the creation and encouragement of more skilled trades in the construction world, right? So they've allocated about $150 million here. And let me just reference it. So $10 million to motivate high school students to pursue a career in skilled trades. Now, you know what? I think that's actually a positive thing, right? I don't know if 10 million is going to be enough, but I think that for many years, you and I, Gary, when we were back in university, we were encouraged to go into white collar jobs. All of us thought that white collar creative type jobs were going to be the last things to go when it comes to AI and robotics. And now, in the last year, we've all learned that no, that's not the case. You know what? In fact, it may be the people who put the HVAC in the building, who are willing to crawl into spaces and put the plumbing in and the electrical in. Maybe those jobs are the jobs that are going to survive a little longer than we would have otherwise expected, depending on how they construct these properties, right? And so, yes, they're encouraging high school students to pursue a career in the skilled trades. They're looking at also foreign credential recognition so that when the internationals who have and will continue to come to this country come accredited in their own country, that they can quickly get accredited to work in construction here. That's a big one we've spoken about on other podcasts. And then lastly here, an apprenticeship service. So again, funding for apprenticeships. So similar to that first point with the school kids. So just more education. So I think, look, if all of this happened very quickly, then maybe they can start to move to that $550,000 new units per year. But it's kind of like this kind of stuff probably needed to have already happened in years past for us to be able to think that we could hit 550 a year for the next 6 years.
Yeah. And there's I was just speaking with a family, with a friend of ours, and their child was, had finished high school, thought he wanted to take a gap year, not go off to university. School was not his bread and butter, we'll call it. Sounds familiar. And he was interested in getting into construction. And I got behind that 100% because right. You won't finish 4 years of university, most likely in debt or taking some sort of student loans. You'll actually be earning money as an apprentice. And what a great skilled trade to have. So if you've got children of that age, or you yourself are thinking of getting into a new career, I got to tell you that skilled trades are a huge necessity. And of course, we go back to the 3.87 million homes. Think of all that opportunity for you as a worker, in fact, or as a new business. That's where that opportunity comes in. Dion, we talked about finding opportunity. That perhaps is an opportunity for you to get into that line of work.
Agreed. Right. Yep.
Good stuff. Sure. Good stuff. So, my friend, let's finish off with this one, because there's been lots of talk about fraud especially over the last 12 months, whether it be through realtors or brokers or what have you. And there's a lot of bad fish out there, but there's a lot of great people out there too. We need to fine tune stuff like this, so the cream can rise to the top, and it's just the nature of where we are, my friends. Because, in my opinion, Dion, we let it get that way. So,
Yeah,
talk to us about how we can, mitigate that risk.
yeah. So I mean, many viewers might remember about a year ago or so, there was a big CBC marketplace investigation into the practices of some people in our industry, realtors and mortgage brokers, who were effectively committing fraud in order for people to qualify to buy these properties. One of the big ones, guys, is the manufacture of notice of assessments and T4s, right? These are federal document. The notice of assessment is a federally generated income document provided by the CRA. And many people in the industry for the longest time have just said, why don't we open up a channel between lenders and the CRA, so that if Gary puts forward a notice of assessment that says 150 grand, the CRA can just say, yes, we can confirm that that is how much Gary declared as income in that particular year. It makes a lot of sense, right? Just one little channel. We're not asking to have access to the entire T1 General or any other information, just one line. It's called line 15,000 on your T1 General tax return. And what that does is it allows that lender to confirm that, yes, the document that has been provided to them by this individual does correspond with what the government has on file. Okay. I don't think it's too much. A lot of people might say it's invasion of privacy and all these other things, but no, I don't think it's too much, right? I think that, property ownership is not a right, it's a privilege. And it's a privilege for those people who can prove that they can service those debts. I can tell you, Gary, in the last year, I have been called by people who were never my clients, but called because they were in trouble and underwater with their mortgages. And when they told me how much income they made, I said to myself, okay, well, these guys would qualify for 800 grand. How much is your mortgage, sir? It's 1.2, 1.3 million, right? And it's not with a private lender, it's with a major bank. The only way that would have happened is if something dodgy was happening in the background. And unfortunately, I couldn't help those people because there was no way there was going to be a lender who would be happy to lend to them, because now they were in a negative equity position, which is a whole nother situation, because again, those realtors sold them properties at inflated prices and basically made it a caveat that if you want me to help you get your mortgage from this dodgy person, that you're going to buy this house at this price, right? It's so many people, unfortunately, get taken advantage of by just a few people in our industry, right? But again, those people really ruin reputations of our industry.
Yeah. Yeah. And I actually, if you were to ask me what is the favorite part about this budget, it's actually a lot less to do with budget as opposed to perhaps policy or in this case, a mitigation piece, or how to mitigate that. I think this is long overdue, something like this, because, it has nothing to do with privacy and everything to do with protection. The Canadian government, or in a sense, us, all of us, we don't want to put people in a situation where the only option is failure. This is an option to succeed, and this will allow that to happen much better, right?
Yeah, I think it's just make the playing field even, and this will only do that. Do that.
Yeah. Excellent. All right, we did a lot today. This is something that Dion and I we look at. We don't always understand it, and when we don't understand it, we continue to ask more questions and ask those that are smarter than us. Speaking of which, Dion, I know that there's going to be a lot of questions that come out of this type of thing. How do people get a hold of you?
Yeah, you can reach out to me at kangamortgage.ca or Instagram at @thedionbeg.
There you have it, my friends. So for Dion Begg, I'm Gary McGowan, and we'll see everybody in the next episode. Goodbye for now.